Welcome back to All Things Money. I'm your host, David Blain. During this segment, we're going to continue our discussion about lump sum payments or annuities as a pension. There have been a lot of changes over at GM and Ford, as well as locally here with PCS Phosphate offering early retirement. So we're specifically dealing here with the question of taking the lump sum or the annuity. The first and probably one of the most arguable important decisions is look at it financially. If the company is offering you, say, $1 million lump sum or $1,000 a month, you got to look at, well, if I took the lump sum, what could I earn myself versus what the company is planning to pay me for? And what we typically see in these is private companies offer a rate of return that is somewhat commensurate with what's going on in the actual world, because they have to make the money and pay it out. And so you'll see, rates of return in the 3-4% range is sort of the ratio. Now, if you move over into the government side of things, some pension plans, teacher plans, things like that, state government, they offer payouts. They're offering the equivalent of 7-8% rates of return on your money. In fact, look at Social Security. If you retire early versus waiting till full retirement age, it's like a 7.7% rate of return on your money. It's much more unrealistic, and that's because the governments have the ability to either print or tax money. But if you're looking at private pensions, the hurdle rate is usually much lower. So you want to look at that first. Secondly, look at your health. If you take the annuity and you get one paycheck and you unfortunately die the next day, that's it. There is no lump sum to get. Their obligation is over with and you forego all that additional income. Of course, you can select some sort of survivor annuity, but we're not considering that right here. Just look at your health. If you're in poor health or your family has a history of dying prematurely, you may want to take the lump sum. Look at your investment skills, or if you have an advisor that you can trust. Obviously, we do this sort of thing. Give us a call or email if you want us to help you. But if you're going to do it yourself, look at your own investment skills. And do you feel like for the next 30 years or so, you're going to be able to keep up with this, or would you rather just have the company send you a monthly check? Look at your risk tolerance. Risk-averse investors probably may want to select the annuity. More risk-tolerant investors, people more confidence in what they're doing, will probably want to select the lump sum. Look at the government protections. That most private sector plans are insured by the Pension Benefit Guarantee Corporation. It is a government agency, but it is funded by premiums paid in by the companies, but it does have that backstop of the federal taxpayers. Private insurers, for example, GM, moving to the Prudential plan, they have much more limited protections through the state guarantee funds. And of course, if you take the lump sum, there's no guarantees whatsoever, so you want to look at that. Here's a really big one that people forget, is you got to factor in inflation. 99% of private pensions do not have an inflation factor. And this mystifies me. I don't understand why they do that. I think it's probably because it would shock people how low a payout they would get if the company adjusted it for inflation. But these company pension plans, most of the time, are not inflated or adjusted for inflation. So if you have the money in a lump sum, you can invest in things that hopefully will be better at keeping up with inflation, Treasury inflation protected securities, TIPS, maybe some REITs, real estate, and of course stocks over the long term serve as an inflation hedge. Evaluate your spending habits. We went through this with a client just a couple of weeks ago and has a real hard time with his spending, spends way too much money. And the deciding factor in us recommending take the lump sum versus taking the annuity provided by his company was his spending. That we felt like if he had a lump sum of $600,000-$700,000 in the bank, and don't forget we were going to be managing this, which brings me to the fact that we're a fee-only advisor. We told this guy, don't take that $700,000 and let us manage it. take the monthly annuity from your company. But anyway, the point was that we felt like if he had this lump sum sitting in an IRA out there, that he would overspend and eventually run out of money. So in his case, we recommended that he take the annuity from the company itself just because of his spending habits. Very important thing to look at. You know, do you have the discipline to maintain your spending? Okay, a couple of pointers there for you. Once again, if you have any questions on that, feel free to get in contact with us. We have a lot of expertise in retirement planning. One other thing on pensions before we get into economic discussion. California back in 1999 made a decision that they would not fund their state contributions anymore, that they would be able, that their pension plans were just fine, that the investment gains would be fine to cover the 100% of retroactive pension increases they granted to hundreds of thousands of state workers. This was back in 1989. And they made this massively wrong calculation, and it's costing the taxpayers billions and billions of dollars every year out in California. And I wanted to point this out to illustrate how the calculations in computing the pensions are computed and how easy it is for politicians to game the system and throw the obligation of these pensions into future years because they just simply don't know what they're doing. The pension system has only earned 75% of what it had hoped to, and it's a big mess out there in California. We're coming up on our second break. When I come back, we'll finish up with this about the California pension system and move on to other topics.